Hi, my name is Ernie Diapara, a top money coach in Southern California. Today we're going to learn the different types of life insurance and its importance to your family. Let me ask you this. If you can save $500 a month, where would you put it? Let's talk about the five pillars where you can put your money. Maybe a majority of you would say, I'm going to put it in my emergency funds like my savings account so that I can save $500 a month. So maybe some of you will say, I'm going to put it extra in my 401k for my retirement funds. And then perhaps if you have kids, you would say, okay, I'm going to put that in my kids' college funds. And some of you might say, okay, I'm going to start paying off my credit card debts and pay extra $500 into it. Very few of you will say, I'm going to open or buy an insurance policy, let's say for $1 million. Now, what if 1 year later you passed and you are the primary provider for your family? So you elected to put $500 a month on your savings account. A year later, you were able to save $6,000. Now that you're gone, you're going to be leaving your family $6,000. What will that do to you and to your family? What about putting extra 500 to your 401k? Will that even put a dent on your savings or on your retirement funds that will sustain your family? What about putting extra 500 to your college funds? Will that even be enough to put your kids to college? What about paying off your credit card debt, paying extra $500? So that means you overpaid your credit cards for additional $6,000. If you have a huge debt, will that even put you out of debt? No. But what if? What if you bought $1 million insurance policy paying $500 a month, although you only paid $6,000? Now you're leaving your family with $1 million death benefit. Will that be enough to give them emergency funds, create a retirement fund for them, or put your kids to college and pay off all your debts? I would say yes. Now that you know the value of life insurance, the next thing is to understand the different types so that you get what is best for your family. Let me talk to you about the different types. Maybe some of you who are thinking about your family, you love your family, so you bought a term insurance, or maybe your company is giving you as a benefit a term insurance, something that we call the traditional term insurance. Let's say you were able to get a 30-year traditional term insurance. I call it a death insurance. Why? Because you have to die within that period. If you didn't die within that period, which is most likely, because 98% of those covered by term outlive it. Historically, it says that only 2% were able to claim during their term. So basically, if you didn't die during that term, all the money that you put in there is gone. Why? Well, even if, let's say you got seriously ill during that period, will that insurance enable to pay or be able to pay for your care? No. So because it's a death insurance, the only way your family could have access to it is you have to die within that period. But what if you can have a term with living benefits? Like your cell phone, insurance evolves. So now they added living benefits into your term insurance, and the cost is not that expensive. It's almost the same. By adding few more dollars, now you can have living benefits. What are the living benefits? Well, now I call it life insurance because you don't have to die within the period if you become chronically ill, which means if you lost two of your six activities of daily living within, if it lasted for 90 days. What are they? They are your continence, transferring, toileting, bathing, dressing, and eating. So for whatever reason, you become temporarily disabled and you lost two of those six, and it lasted for 90 days. So while you're recuperating at home and you're running out of funds, 90 days later, it starts to kick in. So now you started receiving 2% of your debt benefit. So if it's $500,000, that's $10,000 a month. Will that replace your income for now? Definitely. So that will help you solve your problem of money. So with a chronic, and if you get old, and let's say you happen to start needing care within that period, that also pays for your care. Now, what about being critically ill? COVID-19 was found out to be causing heart attack and stroke. That's considered critical. So if you become critically ill, you will be eligible for up to 90% of your death benefit being advanced to you while you're alive. What about terminal? If you become terminally ill, meaning you were given 12 months or less to live within the period, 100% of your death benefit is readily available to your family. How comforting will that be? Okay? So even though you still have a term, now you have access to your funds. Now, whole life, of course, will always be better than a term insurance simply because it's permanent. Now, it also has a cash value that pays 2 to 3%. Of course, it's a little bit costlier than a term, but it has a cash value. Now, however, because it's a whole life, if let's say $100,000 death benefit earned a $20,000 cash value, if you died, whatever is higher is the one that goes to your family. So the $20,000 cash value goes back to the company because you only get, or your family, whichever is higher. Now, they try to improve that by coming up with what you call the universal life. Now you have flexibility. That means you can overfund it so that you can have more cash value, because now the cash value earns about 3 to 4% that is added on to your death benefit. So if you pass without touching any of those funds, even the cash value goes to your family. That's better. However, there is no long-term care in the policy, which is very significant today. And so now they came up with a variable universal life. I won't even take up the details of this because it's variable, meaning you could lose the value of your cash or cash value in the market. So it defeats the purpose of securing a family. So let's talk about the much improved version of it, which is called the Index Universal Life, otherwise known as the tax-free retirement plan inside a permanent life insurance or LIRP. I say it's the best thing that ever happened in a life insurance. Let me show you how it works. As I've said, it's a tax-free retirement inside a permanent life insurance. Why does it have to be inside a permanent life insurance? Because of IRC 7702, which says any investment wrapped around a permanent life insurance is tax exempt. Let me show you an example of a LIRP. Inside, a cash value has a floor of 0.75 and a cap of 15. Let us compare that with the typical 401k, 403, or even your stocks. It plays in the market, so whenever the market goes up, it goes up, and when the market goes down, you go down with it. Like in 2001, because of 9/11, market went down negative 40. If you had 10 grand the day before, you would have lost 4,000 that day. You would need plus 67% to recover your losses. In 2008, the market went down negative 30, so you would need plus 43%. It took me 6 years to recover my losses in my mutual funds because nobody explained to me that if the market would go down, I would get hit. Now look at the LIRP. LIRP is not directly invested in the market, but it participates in the growth. It imitates the market when it grows up to 15%. That is your cap. But the market, when it goes down, you don't participate in the downside market, but you still get paid a minimum guaranteed of 0.75. So that means your tendency is always going up no matter what. That's why it averages 8% for the past 20 years. Considering that this is not going to be lost, it's not going to get taxed, and you have access to it up to 90% because it is not subject to 59.5 rule. What an amazing investment. Now, inside they added a long-term care as a rider. Some of you may say, oh, I already have a long-term care. That could be a standalone long-term care. What does that mean? That means it's specifically for long-term care and it's expensive. So let's just say you're paying $500 a month on your standalone and you die without using it. That is not transferable to your spouse because it dies with you. So everything you paid dies with you. It doesn't transfer. Well, what about this long-term care? Because it's just a rider. Number one, it's cheap. You're paying about $5, $10 to add this onto your policy. And also, it's coming from your death benefit. So if you didn't use it, you don't lose it because either you benefit from it or your family in the form of a death benefit. So let's just say you lost 2 of your 6 ADLs or activities of daily living, lasted for 90 days. Now you're eligible for your long-term care. It gives you 2% of your death benefit monthly after 90 days. So just like what I said, you have $500,000 death benefit that gives you $10,000 a month as a form of an income replacement if you're the sole provider for your family, or if you get old and you start needing care, that will pay for your care so that you don't become a burden to your family nor run out of funds coming from your retirement money. Now, living benefits gives you access to your funds if you become critically ill up to 90%. And if you become terminally ill, it gives you full access up to 100%. Okay? No questions asked, even if you paid only 1 month of your premium. Your death benefit is permanent. It doesn't expire. So if you get old, up to 90, 95, it's still there for you and your family. Now, let me give you an example of how the funds are distributed inside the LIRP. Let's say you have a $500,000 death benefit that over time it earned cash value of half or 100,000. If you pass without availing or using any of these funds, your family gets the whole thing tax-free. While you're alive, however, you are the main beneficiary, that you can actually access the fund, the death benefit, through long-term care, which is 2% of death benefit monthly, living benefit 90 to 100%, and of course in case of death. What about the cash value? It is as good as cash. You don't have to be 59 and a half because it's not subject to that rule. You can access it through tax-free withdrawal up to 90%. Why do you have to leave 10? So that you don't lose your tax shelter. At the same time, you retain all the benefits inside the policy. But you can also borrow from it on a tax-free loan, charging you 2.75 in interest while it earns an average of 8. So it basically pays itself while you're borrowing. So, wow, what an amazing plan. So now that you know the different types, the question is, how much do you love your family? If you love your family, then you want to make sure that they are amply protected. If you are the main provider for your family, you are their main asset. It's funny because a lot of people make sure that their house is insured, their car is insured, even their cell phone is insured. And then you ask them, are you insured as the provider for your family? And a lot of them would say, no. Even if they do, they don't even know if they have the best policy for their family. How much coverage do you need for your family? This is how you compute it. The DIME method. Debt, first you compute how much is your total debt outside of your mortgage. And then number 2 is your income. How much is your annual income times 10? And then your mortgage, how much is your balance? And then the cost of education of your kids. Add them all up, and that's the total coverage that you need to replace you as the provider for your family. Let me help you protect your family. My name is Ernie Diapera. You can call me at 818-390-0155. Let me do a policy evaluation if you already have one, so that we can determine what's best for you. I don't fix if it ain't broken, but I tell you what's best for you to your best interest, because I'm here to serve you. Stay safe and God bless.